Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Welcome back to part 2 of our incredible conversation with Sarah Rohrssen from Atlantic Bay Mortgage Group, talking about everything you need to know to get the right loan for your next home purchase. If you missed our first conversation, go back and check out part 1, where we break down the different kinds of loan options, learn a little bit about Sarah's personal background and business background, and really set the stage for our conversation today. If you haven't watched that one, press pause right now, go back to episode 1, and then come back here after that to learn more and build on that foundational education. If you're looking for the right information or the right partner for you to buy the right house and get the right loan product and understand all of your options, reach out to Sarah at the contact information below. Let's just talk about real quick is like the costs associated with getting a loan, right?
Okay.
There's a lot of different elements, especially when you're working with, if you're trying to shop yourself instead of working with a broker that's just going to shop it for you. There's a lot of things involved.
Yes.
And then I want to talk about just some general rules of thumb and escrow.
Good.
So cost first.
Okay. All right. So let's talk about closing cost.
Yeah.
And I say it with that attitude because people will rate shop.
Mm-hmm. The rate doesn't really matter.
No.
It does, but it doesn't matter.
Right. Correct. Yeah. So the closing costs behind it are what lead to that rate.
Right.
And so this is, again, one of those things where I'll have real estate agents try to shop lenders for the client. And I'm like, that's one of the worst things you can do because
you're shopping the wrong thing.
Yeah. And you can miss out on a benefit. So typically when you hear a super attractive rate that nobody else is giving, what they're not telling you is that their lender fees are higher.
Mm-hmm.
What they're also not telling you is you might be paying a discount point cost. I'll talk about that in a minute, but for that rate. But instead, you just call and they say, maybe everybody's quoting a 7.5% rate. I hope that when this airs, that's not the case.
Yeah.
But let's say it's a 7.5% rate and everybody, not everybody, but somebody's coming in saying, I can offer 6%. Okay. How? Because banks are for profit.
Yeah.
Right?
This is not a charity.
No. Right. So how that works is, again, increased closing costs and maybe a discount point fee. So when you're shopping lenders, what you want to look for is what is their lender cost. So this is where it gets tricky because a consumer is not going to know this terminology, what they're listening out for. So there are 5 terms for the same fee. So there's an underwriting fee, origination fee, processing fee, commitment fee, and administration fee, if I didn't say it. Anyway, you don't know that. So you look at one and their underwriting fee is this. So you look over here, they have a processing fee, underwriting fee, and admin fee. You lump those together, those are comparable.
Yeah. And all, so I've looked at a lot of these myself when people have been trying to shop and they don't want to take good advice. I look at those and I say, hey, all of these, where are they paid to?
Yep.
They're paid to the lender.
That's good. That's really good.
Who's the payee,
yes.
right? Or the pay, or whatever.
Yep.
Who's it going to?
Yep.
Those are all negotiable.
Yep. I like it. That's good. Yeah.
Yeah.
And so we keep our fees low. We have, I'll go ahead and put it out there. Our underwriting fee is $12.95.
Okay.
And so you go to a big bank or a bigger lender, what you're going to see is that their origination fee, that same line item, is 1% of the loan amount. Mm-hmm. Depending on what you're borrowing.
$400,000 loan,
Correct.
That's a $4,000 fee.
Right.
Yeah.
So
but their rate might be a little bit lower.
Right.
But they're getting it up front.
Right.
Yeah.
So the idea is, can you still get that rate with us? Yes. But what's going to happen is we're going to talk about the different options of buying the rate down. And maybe you can get that same rate for a difference of you pay $2,000 here where my underwriting fee is already less. And between the two, you save $700 by going with me and paying to buy that rate down. And I know I just went through that really fast.
No,
it's a little
fine.
confusing. But it's not always what it seems. And then the other thing when buyers are comparing on their own, it concerns me because even the national lenders, they guess at what our insurance is, homeowners insurance. They guess at what our taxes are. They guess at what the attorney's fees are going to be. And so they show, there's a large online lender that I often compete with that airs during football games. You probably know what I'm talking about. They're like, psh. Okay.
Yeah.
All right. So, all right. So
They're all kind of owned by the same conglomerates, and they're all of
yes.
their corporate statements as missions every year and their annual meetings is trying to sell more debt to people that can't afford it.
Oh my
So
goodness.
that's a problem.
Well, and what you'll
If you
find.
use a certain online tax software, it's the same thing. So, yeah.
Good. I didn't know that.
Yeah.
Okay. So what happens is you look at these closing costs, and if you're a consumer, you're going to go, oh, their closing costs are great or are less. That's great. What you don't know is the lender doesn't control those closing costs. So we
Right.
talked about the lender's origination fee. Okay, they control that. The appraisal fee, they don't control it, but they have a part in it. So they're
Right.
going to coordinate with different appraisers to get their amount. Everything else is based on the service provider you use. You choose your attorney, you choose your homeowner's insurance. But then with the taxes, that's the county. We can't control that. So these national lenders will underquote those items to show that their bottom line is better. In the end, you're still going to pay whatever the fees are.
Right.
And so I'll be transparent up front to say, here's what it is for our area.
Yeah.
And now let's talk about that rate. But if you call and what's your rate and you get 6% over here and 7.5% over here without an explanation, go get 6%.
Can I ask you a personal question that you can totally not answer?
Okay, let's
If
go.
you get that call and the first question out of their mouth is, what's your rate?
Yeah.
How do you feel about that potential relationship?
Oh, I got it.
Okay. Yeah.
So
Because if I get that call and the first question is like, what do you charge?
yeah,
I'm like, well, that's a little bit of a loaded question there,
Right.
right? Because I can charge a lot of different ways. I
Yeah.
can also just choose to give you something for free if I want to.
right.
But the reality is, like, this is a professional service. Like, we're trying to provide value for you and actually get you moving forward in the right direction.
Well said.
Cost should not be your first concern. If it is, there's plenty of information online.
Right.
Go find it. Go watch the Working Wealth podcast, get all the information you want, right?
Yeah.
But like the reality is, like, it shouldn't just be what's your cost. It's like,
Yeah.
hey, who's going to walk me through that process with the heart of a
Exactly.
teacher, like you said,
That's right.
to guide me in the best path for my own personal future?
Yeah. So when people
Soapbox
call
done.
and they say, what is your rate or what are your fees?
Yeah.
The reason I say I got it and I like it is because they gave me the first clue of what matters to them. What
Ooh,
matters
that's
to
good.
them,
Yeah, that's good.
it's the savings.
Right.
So let me help you understand where the savings is.
Mm.
So it may be that, even new construction, I compete with new construction lenders a lot. They may have this low rate and this great incentive. Their closing costs are higher, which eats into the incentive. So they're really paying themselves to give you the same product
Yeah.
or the same
It's funny
scenario.
money.
Yeah, it is. But then some things that they don't have leeway with is they're controlled, like they're limited on who they'll use for private mortgage insurance.
Ooh,
So then,
okay.
while that looked like a lower interest rate, their mortgage insurance is higher. So for the first 7 years, and you're probably not going to be in the home that long, right? But for the first 7 years, your mortgage insurance is higher. You could have come to me and gotten a discount. So when people ask those questions, to me, that's an indication of what matters to them. They want the savings. So let's talk about where you're going to find that. And as I talk with them, they see you do care, you do know your stuff. And then I can win them through that. I say win, but gain their trust.
Right. Yeah.
And then something that I do is I say, I have no problem competing. If you're willing to bring me a breakdown of what you're getting elsewhere, let me look at it side by side. Can I
Right.
compete with it, number one? If so, great. But before I even compete with it, I'm going to figure out what's apples to apples. If I can look at it and say, like, again, new construction, some of the new construction offers are fantastic and you absolutely should go get that savings. I'll look at it and say, okay, I've tried everything I can. I can't match that. This is beneficial. Here's where you're going to win. Go get that. Call me if you have questions, if you have a refinance down the road.
Right.
So it really is a conversation. It's not what's your rate, what's your fees.
Yeah. And it always should be a conversation, right?
Yeah.
Like with any kind of big financial decision.
Right.
And that's where, like, the basis of what I said there a moment ago is, if you're just so focused on the minimal hurdle to try to get you across the finish line
Right.
to get that immediate, like, jolt of dopamine for satisfaction of, oh, I got this house,
Oh my goodness.
you're missing the entire picture. Because
Right.
to what you said, like, most people don't stay in houses more than 5 or 7
Right.
years, right?
Right.
People are moving around for jobs, family. They buy that first 3-2 because they think that's what they need, and now they have twins, and it's like, oh my God, I need
Correct.
space, or God forbid there's divorces. Like, there's so many things that play into that
Yeah.
that, to me, it's just very short-sighted to look at just what's the cost. It is important, but you need to understand the thought behind each of those
Yeah.
items and how that works.
Right. And
for
I'll
you.
have people come to me, home buyers come to me and say, I want to do FHA financing because they're doing their own research, which is fine.
Yeah.
You absolutely should start that way. And so they'll come and say, I want to, I want it for the low interest rate. So then we talk about the product. Do you realize the mortgage insurance is higher? Do you realize there's this upfront mortgage insurance? Because the idea is, I want you to look back, and when you go to sell that home, did she set me up to be able to sell this home? Or, oh my goodness, I really didn't understand the numbers. Now I'm not in a place where I can afford my next home. I have to sell this one, but I can't buy the next one. I'm a renter again.
Yeah, right. And let's take that and talk just kind of high level summary, all the different things that will be on a closing statement or like a settlement statement, right? So you have the lender fees, you have all the litany of attorney fees, which we recently just sold some land we bought last year.
Yeah.
And like I'm looking at those and I'm thinking $140 for a courier fee when it's literally going to be an email or an upload of a document from a paralegal. Like, why am I paying $140 because I'm going to upload a document? It doesn't make sense. But anyway, you have lender fees, you'll have the attorney fees, you'll have your prepaid escrow. I want to jump in that, which is like a combination of your estimated taxes and homeowner's insurance. You're going to have maybe some additional closing costs or prepaid mortgage insurance, prepaid interest, all that kind of stuff.
You summed it up. You're doing great.
It's a lot. I've looked at a lot of these things, right? So, so there's all those things. Let's talk about the escrow, and then I want to close out this episode with rules of thumb. So escrow shortage.
Yeah.
From my side. This is where I always talk about, like with realtors, is what are you doing after the close? Okay. You're in a transactional business primarily from the realtor side. Sure. Do you have an obligation after that contract is done? Legally, you don't. Right. It's a transaction. You're paid a commission. That's the whole point of like it's a transactional situation. Ideally, and like the people that I partner with from a real estate side, like they are not about that. It's more about the service and the ongoing relationship. Right. But a lot of people don't think about that. It's like the big thing I push after the close is if I have a client that I've coached on like buying a house and I say, hey, for me, this kind of plays in with rules of thumb. The rule of thumb is 25% of your net pay is the line. Right. I would not go over 25% of your net pay as your total mortgage payment. Right. Total mortgage payment is a combination of your principal, interest, mortgage insurance, and your escrow. You did great. Escrow is your prepaid amounts, like you're putting a sinking fund together to pay your taxes and insurance every year. The mortgage company holds that for you. They're going to pay it for you on an annual basis for the sole purpose of making sure it gets paid. Good job. Like that's what it is, right? That's exactly it, yes. But the biggest problem I have, and I see this all the time, is people overextend on the house. They say, well, my payment's going to be $2,300 a month. Just throw a random number out there. Right. And all the estimates built into the escrow, like for taxes and stuff, is based on prior public records. Yep. And what happens is they buy the house in January or February or March, whatever month it is. The next year, the tax bill comes due and it says your taxes jumped by $1,000 a year. You now owe an escrow shortage of $1,200 to make up the difference. Yeah. We're going to increase your payment by X amount per month, or you can pay out this large amount up front. Yes. And then we'll keep your payment relatively the same. Like, you got it. That's a problem for the budget, which leads to people having to cut back on retirement savings. It leads to other financial stress and pains. It's pain in my butt, right? Like having those conversations where it's like, we talked about this. Yes. Right? Well, it's like, how do you handle that from a lender perspective? So this is awesome. And I'm like, I would love to have a video clip of that to share with every client because I have a clip. Yeah, right. I have. We'll clip it, Josh. I have these conversations, but people are hearing it in the midst of buying a home and like, oh my goodness, the attorney needed something from me, and I'm looking at it's emotional and it's all the stuff they don't understand. It's like I just need to get the next thing done. Yeah. So most recently, I had a couple reach out to me and they're looking to do a cash out refinance because they're just drowning in credit card debt because they're trying to keep up with inflation. And so now the house is a burden, even though they have that beautiful 3% something interest rate. Thank God they have equity.
Right. So they want to do that. And we talked about it, and it's like talking about the whole Dave Ramsey approach, like beans and rice, figure out how to do it and keep that low mortgage interest rate. Right. So that was one scenario where it's painful. So we'll talk about that as far as like really maxing yourself out on the mortgage payment. It's not a good idea. And then the other scenario is an established couple, early 50s, but the home that they could finally afford. Like, we've arrived in life, we're going to do this. Overextended themselves, spent every penny of savings almost. Talk about retirement, everything. And it's just we've worked so hard. We deserve this. That's hard. A good sign of a bad person right there. Yep. No offense, guys. Well, maybe there is some, but like, be offended. Nobody deserves anything. No. You chose to work at that company for 40 years. Correct. You could have left any time in the past. Yeah. These are conversations I have all the time. Yep. Well, and I'm advising against it. And like, here's the concern I see, and just maxing out credit, and which is so American. And so advised against it, talked about all this. They looked for a year and were relentless. So, okay,
Yeah.
at this point, I've given you the insight, but my job is to do the loan, do what you ask. So,
Right.
went through it, and a year later, they're coming back saying, we lost our job. Can we refinance? No, I can't confirm your income. Okay, so we're going to sell it. When can we qualify for a new home? I'm like, you got to get that job. So,
Yeah.
if you're not saving up for a rainy day, you're going to be in trouble. So, let's go back to those escrows.
Yeah.
All right. So something that I do, I'm pretty sure I do this differently than other people, is that I set up your anticipated homeowner's insurance based on what I see coming in.
Yeah.
Where,
the actual quotes.
Mm-hmm.
And that's what you mentioned earlier is like you have to provide an actual quote for this property.
Right.
Yeah.
And so my competitors are lowballing, and then you call the insurance company and they're like, well, it is what it is. Like premiums went up. I didn't know. Well, no, we do know. We do know what the trend is.
Yeah.
So I set that expectation right away. And then that's also a guide so that as they're shopping insurance companies, and I'm not an insurance provider, I'm just looking at trends. So I'm not going to say,
The trend is it's going up.
Correct.
If all of your neighbors got a new roof, it's going up.
There it is. There it is.
If you have a hurricane come 500 miles inland, it's going up.
It's crazy. So, yes, we just seen some crazy
stuff. That's another
stuff.
conversation. Yeah.
Yeah. And so
check out our episodes we recorded with Tim Gaida, local insurance agent, actually.
I love
Those will be
it.
posted soon.
Oh, goodness. Okay. So setting that expectation of what it can be, and then when they shop, that's kind of their guide to go, okay, this is a good premium. Or if it's super low, why is it low?
Right.
And that matters too. Are you underinsured?
Yeah.
So
that's the insurance side, though.
Right. So then the taxes, I do something differently than my competitors do, even some within my office, different than some in my office do. But for me, it's the right thing to do, and that's coming from a budget mindset, right? You need to know what you can afford, not just this is the home and whatever it takes.
Right.
So I have a formula that I've gotten from Greenville County. I have this chart worked out.
Ooh,
Numbers
okay.
nerd, right?
There you go.
Love Excel.
Yeah.
And so I go and I say, based on the home value of what the contract price of what you're purchasing,
right.
Here's what your taxes will adjust to next year. Okay?
Yes.
Okay. So exactly what you're talking about.
If you are looking for a mortgage, please call Sarah.
Right. All right. So let's talk
if you're in
about
South
that.
Carolina, wherever you're licensed, please call
I will
Sarah.
get licensed in other states. That's fine.
There you go. Good. That's my perspective.
Yeah. And so I'm looking at that to say, here's what your taxes are going to be. And so as I'm doing the initial paperwork, I talk with my clients and I say, what's going to happen is before closing, the attorney's office is going to go to the county and they're going to assess it based on the current tax assessment. Right?
Yep.
So it's going to come in less than this, but I need you to budget for this so that when it adjusts next year, you're ready.
Because you're going to get that pink slip
Yep.
that says, here's what your tax rates are.
That's right.
And when you get that, then that's going to go to the mortgage company. And the mortgage company is going to say, oh, we've been receiving this much and this much was paid in.
Yep.
We need to make up the difference. And that's when you're going to get that letter in January that's going to take the wind out of your sails if you're not ready for it.
And so to that point, saying that the taxes are going to be off at first and there's going to be an escrow shortage, I tell people, here's what your payment should be. Yep, at closing, it's come down to this, but you need to save up the difference so that when they come and they do that escrow review and say, we were saving $200 a month for taxes, we had the home undervalued at $200,000, something like that, and now your taxes are going up $50 a month, whatever it is.
Right.
You're prepared for that. You've set it aside because the county can only go off of actual data.
Right.
So it is that shocker. And so they're going to get that escrow review. They're going to be ready for it. But I'm also going to call and say, hey, remember this conversation we had? Because when you're buying a home, so many things. I'm coordinating where the boxes in the moving truck and the pets and all that. And I'm time off work and I got to get to this closing and whatever. There's so much on their mind.
Right.
So we have those conversations, but then we're going to come back and say, remember that conversation we talked about. So in your mortgage payment, your principal and interest, those stay the same throughout the life of the loan, right? The ratio changes. You pay more principal in the payment as time goes by.
Right.
So that part, your principal and interest stay the same, but your payment can change over time. And what that is your taxes and insurance. So that's what we're talking about. That's what you're going to be prepared for. And then maybe all of these numbers make sense right now, but you need to anticipate that as homeowners insurance goes up in our area, your payment's going to go up. So don't max yourself up or max yourself out on those monthly payments.
Yeah. Love it.
Good.
That is like the one thing that just fires me up.
Yeah.
So taking that, we've been talking for a long time, and this has been all super, super valuable.
Yeah.
I want to close out with one final thing, just a recap of the the general like rules of thumb with buying a house, like so I already kind of mentioned one that we focus on is 25% net income.
Right.
Which something else to note on this, a lot of people don't think about is like your net income would also be like post health insurance, post 401k contributions, post HSA contributions. So any of those changes in terms of your payroll deductions or other things like that will affect your net income.
Yeah.
So I would personally, I would consider that as part of that,
Right.
or like at least look at the numbers and understand that to adjust in accordance with that. Are there any other rules of thumb that you would recommend from the lending side when buying a house?
Yeah. And I want to touch on what you just talked about because as a home buyer goes to a lender, we're going to approve you for way more. Mm-hmm. And I typically will ask people, what do you want to be pre-approved for?
Yeah.
I'll stop there. You know, you may qualify for much, much more. I'm not going to open that up. Right. So if this is your threshold.
That used to be the way they did it.
No, now it's like, how much money can we make off of you? Right.
Right.
Horrible.
Yeah.
So that math, that discipline, that's up to you as the home buyer to stick to that. You can ask the loan officer to help you, but, you know, you're giving them credibility they haven't earned yet.
Right. Ooh.
So
that's another podcast episode.
Yeah. Okay.
How to earn credibility.
I love it. Yeah. So you want to manage that. And as far as other things, you know, stay employed. Mm-hmm. If you're going to have a gap, maybe talk with somebody about it. What's the gap? What's going on? Are you going and you're getting a certificate, some kind of education that will back it up? We can use that. Mm-hmm. But if you're...
if you've been pre-approved, don't go buy a car on a loan.
Yes, yeah.
Don't rack up your credit cards.
Don't get new credit. And even when you're under contract, don't go buy new things. Someone had said,
and don't move a lot of money around.
Yes.
That kind of thing too.
Yep. So stay employed. Keep track of your documents. Most recently, I had some young folks, and they just hadn't filed their taxes. I just hadn't gotten to it yet. Yeah. So then they
filed. That's like people saying, well, Christmas is coming up, and I need to pause my contributions to my Roth IRA because Christmas is coming up. It's coming up every year,
I know,
son.
Right? You
Come on
for
now.
It. Yes.
Come on.
So then the other thing that we found with that is once they filed, then they didn't keep their documentation.
Of course.
So yes, everything's electronic, automated. That's great, but you have to have those records. So don't be surprised when you go get a mortgage that we need documentation. Like we're not horrible people for asking that.
Yeah.
That's you showing us, your ability to repay. So be ready with your documents.
Right.
Savings, just be intentional about how you manage your accounts. If money's going in and out, maybe that's a separate account. Like keep your statements clean because we're going to track all the funds going in.
Right.
And just, keep your spending down. Save up.
Be responsible.
Yes.
Live on less than you make.
Yeah. You don't need Starbucks every day.
Yeah. No, I did a clip on Instagram maybe a few months back where it was like your daily coffee habit is costing you $1.1 million.
Over how much time?
Yeah, so like average like $6 coffee,
Yeah.
4 or 5 days a week. If you could have invested that money over 40 years, that's $1.1 million.
Yep. Yep.
So I'm not against the coffee. Just make sure you can afford it.
Yeah.
If you can't afford that, right, let's focus on drip coffee or just drink some water, right? Like
I love it. Yeah.
Maybe you don't need that much caffeine. Maybe you're actually addicted to the high fructose corn syrup in the coffee that you buy from the national chain.
Again,
and with that, maybe that's where we stop right now for today. But this has been super, super helpful. And
good.
I am so excited that we got to do this and talk through things.
Want to try to dive into some content? What do you think?
Let's do this with episode 2.
Like, do you want to dive into that? That's what I'm saying. Do you want to try to do episode 2 now?
Yeah.
Okay.
Yeah. I think we do that. So,
sorry if it was long-winded.
No, you're good. So with that, thank you so much for tuning in. Really, really grateful for you, Sarah, being here for this.
Thanks for having me.
We're going to come back with the next episode, diving into more information about like investment properties and second home purchases and things like that. I think that's a really, really important topic because we talk with a ton of real estate investors or people that are interested in that, right? So tune in for the next episode, and we'll see you there. Thanks. Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.